Welcome back to Switzer and Australia's Business Channel. Positivity seems to be the appropriate word for my next guest, so I can't shut up. I'm going to have to tell him to shut up before we start the program. To describe the outlook for the Australian stock market this year. But what does the master of the market, Anton Tagliaferro from Investors Mutual, think about this optimistic point of view? Anton joins me in the studio. Fund Manager of the Year as well. No wonder you're boasting and carrying on. Good to see you, Anton.
It's good to see
you. No, you deserve it. It's a nice award, and I think a guy like you deserves it, Anton. So tell us, Investors Mutual has been your anchor business, and you created QVE, which is a listed investment company this year. How's that gone?
That's gone well. We listed in August. We raised around 180 million.
Yeah.
And it invests in next 20 stocks.
How? I know it's done well over a stretch of time. It's about what? Is about 108 now, is it?
Yeah. Again, I'd rather talk about the NTA than the share price.
Okay.
We've got no control over the share price.
Okay. Well,
the NTA is up over 7%.
Yeah.
And which is pretty good.
Well, for my viewers' sake, a lot of people wouldn't understand why you're talking about NTA. Why is it important to talk about the NTA?
Well, an LIC is basically you're buying a portfolio of shares, and what's important is to make sure that the underlying assets of the portfolio are going up.
Yeah.
The share price often tends to move independently of that NTA, and as we know in the past, and there's times when they go to a premium, the share price goes to a premium to the underlying asset backing, and there's sometimes when it goes to a discount. So
but
you rather concentrate on the asset
backing. But are you at a premium now?
I think we're at a slight, yes, we are at a premium.
Yeah,
yes.
but when that premium gets too big, that often people will run away from a LIC, won't they? Because the premium's got too big. They think, oh, well, okay, the market thinks it's done well, but maybe they've overpriced it.
Look, as I said, it tends to be a function of the market. When markets are bullish and they're going up, they go to premiums. When markets are bearish, they go to NTA or below something.
Well, this is where I wanted to take you. What's your outlook on the market? Are you bullish or are you bearish?
I'm cautious, Pete, put it that way. I think in the short term you can see why it can keep going up. Obviously rates are very low, not just in Australia but around the world.
Yeah.
And obviously in terms of choices, the equity market still looks okay. But when you look at absolute value, I can't see many bargains. We're a value manager.
Yeah.
We like to buy things when they look really good value. And we look at many companies and go, relative to bonds, I guess they look okay. But when you look at them, stocks like Telstra or Amcor or Coca-Cola, when you look at them, their PEs, whatever, they don't look particularly enticing.
But as you know, there's two parts to a P, the P and the E. And if the economy looked really strong down the pipeline, would that then improve your attitude towards earnings? And then you might have been saying on the show tonight, I can see lots of companies with a lot more potential value.
But why would the Reserve Bank be cutting rates?
But I'm trying.
Yes, potentially, yes.
So part of you...
normally when you get a strong economy, you get rates going up. And I think that's the issue for the world today, is that you have rates are being set on at a crisis level, if you like, and there is no crisis. I mean, if you look at the US, rates are at 0. Their unemployment is down to 5.5%. They're creating 300,000 jobs a month, and they got rates at 0. Now, that's not I'm not quite sure why you'd have an economy with unemployment at 5.5% with rates. The same here in Australia. I mean, things are not that bad where people keep talking about more interest rate cuts. I don't think things are at a crisis where you need to have these drastic cuts. And I think central banks are pushing rates too low, and that's the danger, because it's pushing prices too high.
It certainly worried me last year that we started to see bond yields falling. When we were talking about the US recovering, it made me worry that maybe the deflationists out there were actually going to be right. Now, since probably the last 2 months, bond yields have started to creep up at the same time as Europe has looked a little bit better, but America has looked a lot better. To me, that's a step towards normalcy, that the economic outlook is improving enough for at least bond yields to start going up. What do you say to that?
Yeah, look, I mean, I think the big issue at the moment is, have central banks got their policies right? And that's, I think they're too lax.
Too scared, do you think? That's why they're lax?
Driving them scared. They're still worried about the next GFC, or they're too scarred from the GFC. But as I said, for the Fed to still have rates at 0, I think is they're too low, and those rates have to move up at some stage. Europe, again, you know, they've got rates at 0, which is, you know, they can't go much lower than that. Again, they're pumping €1 trillion into the economy. I'm not sure that's going to necessarily drive jobs, you know. It's going to, again, pump up share markets, help their asset prices, but will it create jobs? That's the question.
One of the points that Tanya Brown-White, who used to be at Macquarie, who now is the Future Fund, was arguing is that because the circumstances are so unusual, this looks like a long stretched out recovery where maybe stock markets only grow by smaller amounts because it's just a long, slow recovery because of what central banks are doing. What do you say to that point of view?
Well, that may be a nice theory, but if you look at the Australian share market, it's gone up, what, 15% or something per annum for the last 3 years in a row. The Dow's at record highs, the DAX is at a record high, so I'm not sure where the slow share market returns, you know, are coming from. So, yes, you would think a slow economy means a slow share market because company earnings aren't growing that fast. But I guess the other side of the thing is rates are so low that it's making equities, you know, but people are buying equities because on a relative, when you look at where bonds are, equities look okay.
Can you buy banks with interest rates so low and the dividend yield and the franking credits that they're offering now?
Look, I think if you held banks, you'd hold them, but I think if I was a new buyer, I'd wait.
Telstra? You've always been a fan of Telstra. What are you saying now?
Telstra looks expensive to me. Again, we still
it was cheap when you were supporting it.
Look, when they were at $3 or whatever, and on a yield of 10% or 8%, whatever it was, Frank, they looked fine. Yeah. Today it's the same company. It's on a P of 17 times or something, 17, 18 times on a yield of around 5, you know, if you're lucky. So I don't think it looks that cheap. But again, relative to bonds, if you're getting 5% on Telstra, people say that looks quite good. But that's the problem, you see.
But part of
we're comparing to these bonds, which look a bit overboard.
And it's an unusual time even for you, a guy who's been in the market for a long time. You've never really worked in interest rates this low, have you, Anton?
So, I don't think any of us
no, that's right. So there's new territory for all of us.
For everybody, and not just low rates, but in some countries they've got negative rates, which I don't think any of us have seen ever, really.
Yeah. Are there any $1 reactive stocks that you like at the moment? Let's assume, I don't know what your view on the $1 is, but let's assume you think it's going to go to at least 70. If you do, are there some companies that still look good value to you?
Pete, the truth is we don't have many exporters left in Australia. You know, there's lots of companies with overseas earnings, like Amcor, like Ansell, like CSL. But it's more a translation impact rather than a cash flow impact. So there's not that many exporters. But look, Ansell sort of still looks okay. CSL, if it came back a bit, I mean, they're good quality companies. They're just
they've been priced to perfection, haven't they?
They're priced a bit higher.
What about Woolworths?
Yeah, difficult one, really difficult one, I think. Look, it's a company sort of in transition. They've got major challenges. I mean, we still own some. Look, the jury's out. I'm not sure. I'm not sure. I mean, obviously, it's more competitive now with Coles, you know, having got their act together.
And Aldi
obviously,
coming.
Aldi's in there. On the positive side, you do have continued population growth in Australia. But there's no doubt it's more competitive. So they've really, I think, they've got the strategy day in May, new head of supermarkets, and they've really got to get you know...
who's actually a pretty good performer, did very well with their liquor. With Dan Murphy's, isn't it?
Yes, but it is very competitive.
What about BHP and Rio? What's your view on them?
I'd be cautious. Look, I think those of us who've been
dividend
around,
stocks now, aren't they? These prices.
Well, if they can keep those dividends, which I mean, you know, some of us have seen, you know, the early '80s we had a commodity boom, and it can take 10 years, you know, for there's been this huge supply built up in things like iron ore, coal. You know, and it's going to take many years for that supply to be, and on top of that, you've got demand in China slowing as well. So, look, I'd be very cautious. So, especially when people start talking dividend yields on commodity stocks. You know?
That's right. It's unusual. That's why I asked the question. Now, one last question before I let you go: is there a company that you like at the moment?
Very few and far between.
I know, but is there one?
Look, if I had to pick one at the moment, look, I quite like GWA.
Where is it?
The Dunnies, Caroma, you know, they're selling off their non-performing businesses. They've got exposure, obviously, to the housing sector. They're not paying a dividend this year because they're out of retained earnings, but looking forward, they should be able to pay dividends. And they're talking about capital returns, etc. They're just waiting for the ATO. So I think that looks reasonable. Again, not sort of, you know, a double your money thing, but it looks okay in a market that in our opinion, looks fairly expensive.
All right, mate. Always great to talk to you.
Good to meet you.
Cheers, mate. So that's Anton Tagliaferro from Investors Mutual and, of course, the listed investment company QVE. After the break, we'll get inside the head of a serial property investor.